Hi there, and welcome to the trade on this Friday morning. Before we get to the charts to watch, let's take a look at what traders are watching. And Japan's core inflation slowing to 3% in February from 3.2% in January. Trump has signed a critical minerals executive order to boost U.S. production. FedEx has cut its full-year results forecast on uncertainty in the economy and bad weather as well. And the price of gold pausing for breath after a record run on safe haven demand, while oil prices have settled $1 higher after the U.S. has issued new Iran-related sanctions. So traders watching some of those headlines today to get across the charts that Thomas Atkinson from FX Evolution reckons we should keep an eye on. He joins me now. Thomas, hi, good to see you again. I love the charts that you guys bring to us. And I'll just, start going through them. I understand you've got Telstra for us.
Yeah, we've got quite a few charts here today to obviously discuss. So thanks for having us on the show as always. Yeah, so Telstra is, it's an interesting one because generally Telstra has been not that interesting, I guess, in the last couple of years. And it looks like it's starting to find its own powers, I guess, in terms of price action. Some big breakouts here over the last week, specifically targeting in at around that $4.07 to $4.10, a close above there on the weekly, I think, really showing momentum from the biggest funds. One of the big things here on the chart that users or viewers will be able to see is that there is a huge amount of confluence around purchasing. There's these kind of like a big red line that's kind of coming through the chart. And what that actually is it represents the most traded level or most traded zone by funds over the last kind of 2-year period. And what you'll be able to see is that we've respected that zone only a week ago, or a month ago actually, and then found a significant buying pressure. So I think that Telstra is coming into its own. And part of the reason why this, and we'll go through it later on today's show, is that I think that the market's starting to enter into what we call late cycle investing, which tends to be where we see utilities, certain healthcare stocks, some metals and mining, and of course, in this case, telecommunications, doing much better. So Telstra's, looking very good. Close at 450 next target.
Yeah, see that big green candle there. Sorry, I missed where the next target is. Apologies.
Just around, probably around 450, probably 440 to 450.
Got it. Thank you. Now, the next chart is one that has, garnered a lot of interest amongst our viewers as well, because where gold goes, I've said it before, silver usually follows. What are the technicals telling us?
Well, Nadine, we've known each other for a long time now, and you would know that we've been on the show a long time talking about gold to 3,000. So firstly, congratulations to anyone that's been on the gold bandwagon. It's been an amazing run. 2 years ago, we really started thinking about 3,000, and I actually think there's even more in it. It was a mixture of geopolitical tensions back then that we already thought were starting to emerge, but now we've got even stronger reasons to believe that, of course, gold can do well in the current environment. Even if we go into stagflation, a lot of people won't know, but stagflation is actually very positive for gold, not so good for the economy, so watch out for that. But the big thing here is, of course, silver. Silver hasn't really been playing catch up in the same way. Now, we've got a really, really big chart here, a 1-month chart. And the reason we're bringing that up is because people probably aren't familiar with how silver ran back in 2010, 2011, when it hit its highs at almost $50 an ounce. Now, at the moment, it's doing okay the last couple of weeks. It's actually been our preferred metal over the last kind of month, and it's been performing better than gold. But if it manages to break through that current resistance level that we're basically hitting at this stage, which is around 34.60-ish an ounce, there's really nothing on the left-hand side to stop it from moving up to the 40s. And I think that's very exciting as precious metals traders and particularly silver traders, because if prices continue to go up, there's nothing really that's going to stop it from a technical standpoint on the left-hand side. And this is what we like to call equilibrium move to equilibrium move. So once flow breaks a zone, then suddenly all the algorithms and everybody starts piling on. So as you've seen, people are interested in silver again, first time in a while. Exciting times for silver, looking good.
Yeah, congrats on the gold call. It's done really well. I hope people were listening out there. Lynas is the next chart on your list, and I think that this is such an interesting one to talk about because, we've just got the U.S. president signing an executive order over critical minerals. We've got similar, security concerns, security of supply concerns here in Australia. Lynas can produce rare earths, it can process rare earths, but for some reason it's been a laggard. Is that about to change?
Yeah, we believe it could be. And this is not just, of course, America, Australia. This is the world. Everybody, with everything that's happened this year in geopolitical, I think whether we like it or not, there's going to be a move to superior, like a lot of defense spending. And that's going to be, percentages of GDP. We've already seen Europe up their GDP spend massively over the last month. And this has meant that there's going to be a lot of demand for particular rare earths and minerals. Now, some of these rare earths, if you want to look into it, they're so rare and they're needed for certain things like fighter jets and stuff that it's just that they're almost owned by just a few businesses. But with Lynas, obviously, they do have some of the rare earths, and they've been kind of a laggard again since 2022 and the period where we saw that really hyperinflation. So we're liking the rare earth minerals and metals. They're very difficult generally to invest in, but all of them are low. So it's not like we're coming off, just Lynas underperforming. It's been so many different rare earth mineral metal stocks that have been really hit over the last couple of years. And as viewers can see here, again, another large chart, because I think these are important to look at, what we call an inverse head and shoulders, left shoulder, head, right shoulder. Again, a bottoming formation that's taken 2 years to form. Very strong monthly close looking to happen this month at the end of March. And that's going to take out a lot of those wicks that are sitting around $7.40. And the thing about that is it again shows us that flows of the largest funds are starting to come into these. And it doesn't matter whether you're looking at a code like REMX, which is just a rare earth mineral ETF in the US, or any of these types of things, you'll see the same types of patterns. So we're liking what we're seeing here in the rare earth mineral space, and it's the first time in years we can actually say that.
Yeah, great. Love it. It really dovetails nicely with a virtual investor event that we're holding here at AusBiz in April. So I might give you a call about that one after, if you don't mind. Good. All right. Let's get to the market in general, though. So the index, the S&P ASX 200. Earlier, we were having a bit of buying pushing into the market, and I said we're getting awfully close to that 8,000 level, but not to be today. Technically, how vulnerable is this market looking?
It is fairly vulnerable, but the great news is the level that it bounced off. So again, big red arrow towards a wick. Wicks do matter in technical analysis. The reason is it shows excitement in markets. So effectively, if someone's really excited to buy, they buy quickly, and that creates these types of very heavy pressure events. And you'll actually notice on this chart, whatever you've seen wicks, usually the next move has been in that direction. So that's good. The other good news is that big red line again, the most traded zone. I actually highlighted from the 2023 near lows all the way till the 2025 highs, so we could see this, and we've just come off the most traded zone. So again, one that traditionally funds probably were purchasing because the market ended up going up in the past, and it's what we call a demand zone. So I think good news is we hit a demand zone. Good news is it's actually in the US as well, which we'll see in a moment. And the bad news is the speed at which this went down at. In terms of the US anyway, it was the 5th fastest correction ever seen. So we've just witnessed something that you don't see every day, equal 5th with, I think, the Asian crisis and some other point. So what this all is telling us is the market is spooked. There are serious concerns out there. And at the moment, we have to look for structural recovery. You mentioned 8,000. That's going to be a critical psychological level to get it back above. But I'm confident that certain things, especially the Fed put that we might have just seen started to be placed with the end or partial end of what we call quantitative tapering, that's all coming through. So I would like to say we're going to see a rally bounce at around these levels. And even if we go lower, I still think that it won't be that bad, and we'll see a rally. What happens then? Hopefully we're on the show to talk about.
Yeah, okay. I'll let you get away with that. Now, when we get to the S&P 500, I had a conversation earlier today with a guest who reckons that there could be further to go in this correction. Yesterday, a gentleman from T. Rowe Price was telling me he thinks that the possibility of recession is not yet priced in. He's looking for a 10 to 15% further correction. Not that the U.S. will necessarily go into recession, but he said you just have to see the markets pricing that in before they'll be able to sort of push higher from there. What's your view?
Well, it's a very interesting view. That would be taking us into what's called the technical bear market. So again, 5th largest correction, that is movement down 10% from top in history. Some stats that will agree with that, I'll give one straight away. There's a green line here. That's what we call the 200-day moving average. It's very important not to stay below that for too long. Now, unfortunately, what happened was from the top, we took the 200-day moving average on both the S&P and the NASDAQ. And what that did was it started a really bad statistic. And that statistic was whenever we've seen that in the past, if we lose 3.5% under the 200-day in 2 weeks, that we would actually be in for only three other times in history: 22, which was a bad correction, GFC, and .com. And that's not good. So that actually happened in a day, being Monday last week. Now, what does that mean? It means that we have to be absolutely hyper vigilant on the way that this recovers if it does. So we've also got, there's so many stats we could go through, but predominantly you're wanting to look at this 200-day moving average. If price gets back above it, holds it on a weekly close in particular, I think that's a good sign that recovery can come through. If price comes up, tests it as resistance, which is what we initially expect to happen, and then goes and makes a new low and doesn't instantly recover that, then it's possible that those horrible, not very good predictions, I guess, because they would be pretty horrible, 10, 15% from here would not be good, could come true. The markets are definitely not in for recession, though. To answer the question simply, they're still hoping for tax cuts and still hoping for deregulation.
We will see. And I suppose with U.S. quarterlies coming up, we'll get a lot of company commentary as to how they are seeing the landscape panning out. Thomas, that's a pleasure for us. Thank you so much for joining us with your charts.
Can I say one other thing just before I leave? I just wanted to say a big thank you to everybody that's been watching on the show and everybody else. We actually managed to achieve 200,000 subs on our YouTube channel today, so that's really awesome to see.
Congrats. Yeah, send them over our way as well. Okay, Thomas, take care. See ya. Thomas Atkinson from FX Evolution, celebrating a YouTube milestone.